Hey everyone, really excited to be here today. We're going to talk about a quite interesting subject in VC land, which is failure. The context for that discussion is that there's a lot of discussions around unicorns, decacorns, IPOs, and VCs really like to talk about their massive successes. But the whole dark side of venture capital, which is what happens when companies don't succeed, is not so much covered. So I asked three brave VCs to join me on stage and talk about the subject. So I think it should be quite exciting. And so the first question that I would want to ask our panelists here is, how do you typically define failure? What are your expectations when you invest in companies? And as we talk about this, maybe present and introduce your companies quickly.
Where do you want to start?
Go ahead.
Okay, I'll start then. All right, cool. I think, probably people in the audience are sophisticated enough, so I think you probably know about power law and venture capital, and I think that's very much the case, so I won't belabor that. But I think from VC fund to VC fund, stage to stage, that kind of, that number around what's acceptable to write off or to have fail is probably a bit different. And for us, because we're seed investors or pre-Series A and very pre-Series A in the sense of pre-seed and seed, our acceptable failure rate is even higher probably than later stage capital. So for us, that's 60% probably, but we don't see that in actual reality. It's more sort of 30%, but I would say between 30 and 60, 70%, even a 1x return for us, is meh. It's not zero, and so it's better than nothing, but it's still pretty meh, right? So for us, it's really the top 10, 15% of returns that are more the better multiples or even multiple fund returners.
Thanks. Rob, would you?
Yeah, so when we look at a portfolio, and a typical portfolio will be invested over about 3 years, new companies, it'll be about 25, 26, maybe 30 companies. We think it's about a third. That's what we tell our investors. A third, they're not going to work out. They're going to return less in capital, maybe be zero. There'll be a middle third that'll return capital, maybe a little better than that. But there's a third of the portfolio where you have 2x, 3x, 10x, 20x, and that's what drives the returns of the fund overall. And this idea of the power law, the idea that there's one or two investments in the portfolio that break out, is what investors and venture capitalists are really looking for in the portfolio to make it work out overall.
Yeah, some really great points were mentioned, and I myself am from FRESCO Capital, and we invest also in very early stage, so pre-Series A type startups globally. And really great points mentioned, but Rob mentioned investors. So I'm sure, again, you guys are sophisticated, but you understand that VCs operate with investors as well. So we have our LPs in mind. And this, I don't think we really talk about a lot when we talk about VCs and their, unicorns, chasing unicorns. So I think the system itself, the larger picture is very important as well. So of course you know that VC is part of the PE, a private equity type asset, and we have investors as well. And so even in the investor communication, we talk about this extensively. And of course we have some target returns, but we talk about, at least for FRESCO, we might be a little bit unique, but we talk about making good investments with good entrepreneurs that are ethical practices, net positive impact on society, and solving real problems. So we really emphasize that, and we align that with LPs. So some LP monies we won't accept, and I think recently we've seen a lot of scandals or news about LPs or LP money coming from certain regions, and also startups, being really pushed by kind of this VC LP kind of dynamic to make, fake some numbers, et cetera. So we really try to avoid that by aligning with our LPs from the very start.
I think one thing that's interesting is, I think we're all investing pretty early here, is that there's always this phase where you don't know where a startup is doing well or not, and then at a moment you kind of realize that things are probably not doing the right way. We had a discussion with Rob about this, preparing this talk. So what typically leads you to understand that? What gets you to the point where you feel, okay, this is probably not going to work, and how do you handle this? Rob, do you want to?
I actually, so I sort of disagree that you don't know for a while. What we've learned, I think, particularly in doing this over 11 years, is there are some very early signals that correlate with failure versus success. And so we've bucketed them into, or we identified them as two kind of early indicators. One is failure to communicate and failure to action. It starts with failure to communicate. We make an investment, and it goes dark. So, all the kind of back and forth and emails and all that chatter that we had pre-investment, suddenly, we're ghosted, kind of like dating. And so, and it's huge correlation with who succeeds and who fails in our portfolio is that kind of open communication during the good times, the bad times, the challenging times, and a real approach towards how do we get our investors, advisors, employees around the table to help solve problems or give us feedback or whatnot. And that failure to communication, again, is correlated with your failure to communicate as a CEO founding team with your users and your customers. So it's not like you're just ghosting us. You're probably pretty bad at communicating with product market fit, right? So you can't get to product market fit. And then the second is, even if you're good communicators, failure to act. So we see a lot of our founders, they take in a lot of advice. So they're always reaching out, pulling from our resources and asking for mentors and talking to us and making lists and doing things. But the actual action is negligible, right? And there's nothing actually happening. And so well before product market fit, well before KPIs and traction and sort of seed, Series A even, those are two pretty leading indicators of the mass, the 60% who will be meh or fail versus the top kind of third who will really succeed.
Rob, would you agree with that?
Well, this question of communication is a very interesting one. How many people in here are entrepreneurs? Raise your hand. Okay. And how many are founders? Raise them nice and high. Okay. And of the founders, how many of these have taken outside capital? Raise your hand as well. Do you enjoy calling the people that are invested to give them bad news when you're afraid? Of course not. And it's very challenging, but this correlation that we were just talking about between communication and companies that are successful, it's very high. And the thing that worries me more than anything else with a company that I work with is if they go silent for a while, it's unlikely that they're silent for good reason. I'm sure you've seen this as well.
Yeah.
And the piece that's important is if you keep your investor informed with what's going on, there is a level of trust there because you're having trouble, you need to work hard, you don't want somebody that shows up, and I'm saying this with air quotes, to help, and they end up asking a lot of questions, but they're not making, say, a key introduction or giving you some perspective. But if you have an investor who really wants to understand your business and is able to give you a few things that are very actionable or an introduction, it's likelier that that investor is going to want to help out if you can't raise outside capital, if they believe in the business, and help you with a bridge, because the bridge ends up being based on trust and belief in you. And if they don't have information about what's going on, it's a lot harder for them to make an independent assessment of, yes, we're going to back you in lieu of outside validation that it's working out.
Yeah, I just have to echo everything that you guys said. And for the communication part, we would also approach that from the very beginning before we invest. So make sure that communication, so Reshma was saying that, before the investment, yes, the communication is really enthusiastic and very pitch mode. So we actually try to avoid that with our partners. When we talk to companies before we invest, we try to question them, and you might think it's a little bit mean. We're not trying to be mean, but we would give them kind of strong feedback, open feedback, and we see how they respond to it. And I know, startup founders here, you treat your company as your baby. And of course, you don't want to hear that your baby is ugly. We're not trying to say that, but we're trying to ask, have you thought about this? Or what would you do if X, Y, Z? And we see if these founders are, open-minded to those questions and say, oh, I actually haven't thought about that. This is, perhaps a way to think about it, et cetera. So when we see that, that's a relatively positive sign, and that our communication in the future going forward is better. So that's something also, the correlation that we see.
And so I think that leads us to an interesting point, which is what do you do when you see a company failing in your portfolio? There was an interesting question in the room regarding a post from Fred Wilson, basically saying that VC is owed to portfolio startups to help them in struggling times. So how do you typically think of that, and what are the action plan on your side?
Well, I think actually, there may be the Fred Wilson post that you're talking about, but in general, a lot of investors actually spend more time on the companies they have trouble with than the companies that are really working out. And investors in venture capital firms tell the venture capitalists, you should make sure you're spending more time with the winners. But in reality, you really don't like to see the companies that aren't working out not work out. So people end up spending a lot of time helping those companies out. That tends to be what happens.
If I could add, of course, I think the communication part, again, is what we're talking about. There's not a magic formula, but it takes time. And in the VC world, we're always talking about, time is money and, 5x growth per year, et cetera. But these things take time, and we know that. And with communication with our founders, I think that there are certain stages where you develop these certain type of trust-based relationships. And I think when we sit down with our founders that are struggling and take that time, then they're like, oh, they can help us, and oh, we can stop kind of being in pitch mode or everything is great mode, and actually talk about ideas that you might think are stupid, or pivot ideas, or questions that you're really not understanding, if it's just cash flow management, et cetera. If you start asking those questions that are actually real and not, you're not trying to make a good impression about yourself, I think that trust relationship builds up.
Yeah, and one of the things I neglected to say when investors are spending time with companies that they're involved with that aren't working out is reputation really matters as an investor. So when a company starts to have problems, you're not reachable. The entrepreneurs talk about that to other entrepreneurs. So that reputation management is extremely important, and it's part of the reason that people are willing to put in the time. And the second thing is, when you're talking to people about it, whether you're looking at burn rate or you're looking at hires, et cetera, you try to focus on a few key things that can be done. And rather than trying to run the business, you're thinking about, are they thinking about it in the right way? Do they have the right people in place? And are there a few key things that they need to focus on to turn around, say, in the go-to-market strategy? Or do they have the right people in the sales team, et cetera?
We take quite a different view around failure, in the sense that when we're investing, there's not a lot of money at risk. There's not a lot of kind of employee well-being, and numbers of employees at risk, and there isn't market risk as such in terms of leaving customers and users cold and high and dry, because we're often, the biggest failures we see, or the greater number of failures we see, is before product market fit. And so, partly we see our job as helping you fail, and helping you, realize the company is failing to deliver on a product market fit, and it's better to shut down, and better to shut down well, and have enough money to go, liquidate the business well, and treat the few employees well, and so we really try to help in that journey and help advise in that journey, because what we see is when that's not done well, a lot of the kind of emotional issues, founder issues, things that actually matter at the end of the day, kind of life and death, really kind of crop up, even at these very early stages.
There's one interesting question in the room, which is, have you seen companies that you believed you didn't believe in? You were like, this company's dead, and you saw them emerge and become a massive success afterwards?
we haven't had a massive success emerge out of something we thought would never work out. I mean, I guess we wouldn't have invested, or that, you know, over time even that we thought. We've had reasonable success, which for our fund is not so meaningful, but for the company and for their employees, it's meaningful. So that's really nice to watch.
Yeah, we're investors in a company called Nextdoor. For people that are familiar with Nextdoor, when we originally invested in Nextdoor, and my partner Jason Pressman led that investment and serves on their board, it was originally called Fanbase, and they were building a Wikipedia for sports. And needless to say, that didn't work out, and they ended up doing a pivot to head towards where Nextdoor is going right now. Now, Nextdoor hasn't gone liquid yet, but it's on a really interesting international trajectory now.
Interesting. There are questions about the highest exit multiples, but I think we're not here to talk about that. One point that you touched, Reshma, was what do you do when you see a company and you feel that it's not going to work? How do you have this conversation with the founder about closing the company? What is your typical advice when to make that decision and how to make it?
Well, I think in some ways it's the reverse of what we were talking about with communication. So with the company, you can start to talk as an investor well in advance of when they're going to run out of money, how you view the company, and the prospects for the company. So it ends up being driven by, does it look like it's fundamentally a good business on a good trajectory? And if we believe in the business and the team, we'll start to telegraph earlier, hey, you're going out, you're doing the right things to raise capital, maybe this sector is out of favor, we're open to a bridge, or we'll say something. How many people in here are familiar with the bridge financing, interim financing? So it's the idea that you're bridging to a round of financing. Now, if we look at it and we think it's a pier, not a bridge, then we'll communicate to the company, hey, if you can't find a new lead, it's unlikely that we think that we should collectively be going forward with the business. And then it allows the entrepreneurs to start to plan to figure out, is there the opportunity to move forward? How do I go through this? Do I need to find an acquirer for the company in the meantime? So it's literally communicated 3, 6, 9 months in advance to be really clear with the entrepreneurs so they can think about where to go with the company.
Yeah, just to add, a pretty much similar thing, but when the company's not doing well and, again, not well enough for a bridge round, et cetera, I think the founders at this point really understand that as well. So they don't need a VC telling them that, they need to find an acquirer or, really try to raise a bridge round, et cetera. So I think the founders, they're mature enough, they're humans, great entrepreneurs, but just, the market wasn't right oftentimes. And so, we would let them kind of help us help them. So make sure that they're, they're not feeling like we are saying something that they don't want to do. So we just make sure of that.
And I also want to talk a bit about what happens afterwards. So a company fails, whatever the situation of the company. How do you handle the relationship with the founder afterwards? Would you back a founder of a failed investment? And if so, what would basically be the kind of the key drivers for you to make that decision?
I mean, 8 out of 10 times, yes, for sure, and we've done it multiple times. I'll go into sort of one of the reasons why we wouldn't, but so, biggest things is they've learned a ton. They've learned it with our support and our sort of governance and an eye on that, right? And so I think if they've failed, having sort of done really well on the art of communication and the art of action, then absolutely. The one area though we won't, one area where we won't reinvest is if a founder does something completely different where we don't see a founder market fit. Obviously, it's probably going to be somewhat different, right? Because the first thing failed. But if it makes no sense why that founder is necessarily doing this other thing, then that's probably one reason we might pull back and shy away. But the amount of learning that's gone on in that first failed startup, it's it pays back in spades when you reinvest in those founders.
Yeah, I think just to add, most of the times I think we also would support a lot of the founders. I don't know if it's 8 out of 10 times, but because we have built that relationship, so that social capital is there, so especially yes, and they have learned a lot. But and also, even if we don't support them in terms of investment, perhaps, we're always open to make references, etc. And even in the cases where they're trying to do something completely different, if it makes sense, if the founder market fit is there. So for example, we've had cases where, founders have exited a certain company or failed a certain company, but they wanted to go back into their family business, for example, and that kind of background was there and the passion was there, then yeah, we definitely support it. So we've seen that before as well.
All right, this is very frustrating, but I think we're out of time. Thanks so much for sharing your insights. Learn a lot. Thanks.